If you receive the state pension in the United Kingdom, or pension credit, or PIP, or any kind of support from the Department for Work and Pensions, and you have spent the last week feeling uneasy about a video doing the rounds, the one with the red cross and the words "terrible news," starting June 2026 in the title, "This One's for You." You've probably seen the claim that from this June, the Department for Work and Pensions is going to start looking inside the bank accounts of people on state pension, pension credit, and other DWP support. And the comment sections are full of people asking the same question, in different words. Does this apply to my state pension? Is my pension really a benefit the government can monitor or claw back the same way they handle universal credit? That confusion is completely understandable, because the official wording is genuinely tricky. Two completely different things share the same legal word. And a lot of what's circulating right now mixes them up. Today, calmly, with the official guidance open in front of us, we go through exactly what these new powers do, exactly which benefits they touch, and exactly which they leave alone. Stay with me, because the single sentence that answers the question keeping most of you up at night is sitting in writing on the government's own website. And we read it out loud before the end. By the end of this video, you will be able to say, in one short sentence, whether the new bank monitoring power applies to your pension. And if a neighbor comes round in a panic next week, you will be able to settle it for them too. Quick context before we go further. This video is made for pensioners and pre-retirees in the United Kingdom, over 60 navigating the state pension and Department for Work and Pension support. The goal is simple, to help you understand a set of new rules that are genuinely easy to misread, so you do not panic about something that does not apply to you, and so you do not miss something that does. Everything I share today comes from publicly available official guidance, the official Department for Work and Pensions fact sheet on the new eligibility verification powers, the published DWP Code of Practice, the House of Commons Library research briefing on how savings affect benefits, and Age UK's published pension credit fact sheet. I'll name each source as we go. This is educational content only. It is not personalized financial, tax, or legal advice. And nothing here is a promise that you will receive any specific amount of money. Everyone's situation is different. So, before any major decision, please talk to Citizens Advice or a licensed advisor who knows your circumstances. Now let's draw the line that the viral video forgot to draw. I am not here to tell you what to feel. The way successive governments use the same word benefit for completely different things is genuinely frustrating. And the comment sections are right to push back on it. What I can do is read you what the official guidance actually says, in plain English, and let you decide for yourself how worried to be. If you find videos that walk through the official guidance line by line more useful than videos that shout about deadlines, subscribing helps you find the next one. That is the only reason I am asking. Before we begin, did the wording in that viral video confuse you, the way it confused thousands of people in the comment sections? Drop a quick reply below. Your comment helps other viewers feel less alone in being unsure. The first thing we cover, and this one matters, whether the new June rules apply to you or not, is your overpayment rights and the 1-month mandatory reconsideration window. If a Department for Work and Pensions overpayment letter ever lands on your doormat, whether you believe it is correct or not, there is a single most important fact. The clock that matters is the date printed on the letter, not the date you opened it. Under the standard DWP appeals process, set out by Citizens Advice and grounded in the Social Security Act 1998, you have 1 month from the date on the decision to request what is called a mandatory reconsideration. That is a formal request asking the DWP to look at the decision again. Citizens Advice describes it as the first formal step and notes that if you ask for a written statement of reasons within that first month, your window extends by up to 14 extra days from the date the statement arrives. Pause this and write this down. The 1-month mandatory reconsideration deadline starts on the date printed at the top of the letter, not the date you opened it. That single piece of timing has saved thousands of appeals. If the overpayment came from a DWP official error and not from anything you misreported, both National Debtline and the official government guidance flag that as a separate, important factor. Wait until item number 2, because that is the one that actually resolves the question keeping most of you up at night. The next piece of real news, and this one is genuinely new, concerns personal independence payment, known as PIP. On the 2nd of June 2026, a set of regulations called the Universal Credit, Personal Independence Payment, Job Seekers Allowance and Employment and Support Allowance Decisions and Appeals, Amendment Regulations 2026, came into force in England and Wales. What they actually do, and the Disability News Service and the Department for Work and Pensions have both confirmed this in writing, is allow the DWP to extend existing fixed-term PIP awards for most claimants aged 25 and over. That means a minimum of 3 years between reviews, rising to 5 years at the next review if entitlement continues. Claimants under 25 and those with severe long-term conditions are handled differently. This is not an eligibility change. It is a review frequency change. The TIMS review of PIP, a separate, wider piece of work, is expected to report in autumn 2026. Until that review reports and any new legislation passes, the rules for qualifying for PIP have not changed. The flip side, and this matters if your condition has worsened, the DWP is now less likely to come back to you automatically for some time. The responsibility to request a change of circumstances review sits with you, and Citizens Advice can help you do that. Now, item 1. This is the one that has been quietly costing people money for years. The viral video, and dozens like it. Repeat that. Pension credit has a £16,000 savings limit, the same as universal credit. According to the House of Commons Library, research briefing on how savings affect benefits. That is incorrect. Pension credit does not have an upper capital limit at all. What pension credit actually does, and this matches Age UK's published pension credit fact sheet, is this. The first £10,000 of savings are disregarded completely. Above that, for every £500, or part of £500. The DWP treats you as having £1 extra a week of what's called tariff income. That tariff income is added to your actual income when the pension credit calculation is done. It can reduce your award. It does not, on its own, disqualify you. Pause this. Pension credit disregards the first £10,000 of capital. And there is no upper savings cap. The £16,000 figure does not apply to pension credit. A worked example, drawn from the Age UK fact sheet. Picture a pensioner with a state pension of £110, 75 pence a week, and £11,026 in capital. That is just over the £10,000 disregard. The excess generates £3 a week of deemed income. Combined with the actual state pension, the total assessed weekly income is £113, 75 pence. They are still entitled to guarantee credit. The reason this matters is that thousands of people every year talk themselves out of even applying for pension credit because they have heard a wrong number. 12,000 in a building society, 15,000 from an inheritance. People assume they are over the cliff. There is no cliff. Keep that £10,000 number in your head. We come back to it in the recap. Next, we look at the new power everyone is worried about. So what does the new power actually do? Here we go. Slowly. From the official Department for Work and Pensions fact sheet. Last updated June 2025. The law is the public authorities. Fraud. Error and Recovery Act 2025. Royal assent was on the 2nd of December 2025. Implementation begins from 2026 in stages, after the codes of practice were finalized. And the consultation on those codes ran from December 2025 to late February 2026. The power itself is called an eligibility verification notice. The DWP sends a notice to a bank or building society. The notice contains specific eligibility indicators, for example, the savings threshold that applies to a particular means-tested benefit. The bank checks its own data against those indicators. If a match is found, the bank returns a narrow set of information to the DWP. That set is the account holder name, sort code, account number, date of birth, and account balance. That is the entire data set. The DWP does not see your transactions. The DWP does not see what you spent on shopping. The DWP cannot open your bank account. A match triggers a review, not an automatic deduction. And a human caseworker must be involved in any decision that affects entitlement. The benefits currently in scope of an eligibility verification notice, according to the official DWP fact sheet, are 3: universal credit, pension credit, and employment and support allowance. That is the full list at launch. Let me give you a picture of how this lands in real life. Picture a composite character. Call her Margaret, 68, in Manchester. This is illustrative, not a real case. Margaret watched the viral video at 11 o'clock at night and barely slept. The next morning, she rang Citizens Advice. Within 15 minutes, the advisor had read her the same line I am about to read you. Margaret's state pension was not in scope. Her modest savings sat below the pension credit disregard. She had been avoiding pension credit for 2 years because she had heard the wrong number. That is the cost of the confusion. It is real, and it is preventable. And one of these items completely cancels out the panic in that viral video. That is item number 2. And it is next. Now, the question that started this whole thing. Open the official Department for Work and Pensions fact sheet on the new eligibility verification powers. It is on the government's official website, updated the 19th of June, 2025. Halfway down the page is a single sentence, taken directly from the official document. The fact sheet says, in writing, that other benefits could be added to the eligibility verification scheme with the approval of Parliament in the future. And then, immediately after that, this, quote, the state pension is explicitly excluded from the power and cannot be added by regulations, end quote. That is the answer. The state pension, the contributory one you built up over a working lifetime of national insurance contributions, is explicitly excluded from the new bank monitoring power. It is not just outside the current list. It cannot be added later by regulation. To bring the state pension into scope, Parliament would have to pass entirely new primary legislation. Pause this. The official DWP fact sheet says, in writing, that the state pension is explicitly excluded from this power and cannot be added by regulations. A word on the wording that has had so many people angry in the comment sections. The state pension is, in fact, legally categorized as a contributory benefit. The House of Commons Library briefing on the state pension confirms this. The term comes from the original 1946 National Insurance Act and the Social Security Contributions and Benefits Act, 1992. The word benefit in that phrase is a legal technical term. It sits alongside defined benefit private pensions and other contributory schemes. It does not mean the state pension is means tested. The state pension has never been means tested. Your national insurance record buys your entitlement, not your income or savings. So the headline you can take into your week is this. If your only Department for Work and Pensions income is the state pension, the new bank monitoring power does not apply to you. If you also receive pension credit, universal credit, or employment and support allowance, the eligibility verification power can be used on those means-tested benefits, but the information the bank returns to the DWP is narrow. A human caseworker is required, and you have a right of mandatory reconsideration and tribunal appeal at every step. 5 things to take with you. Counting down. Number 5. If any DWP overpayment letter lands, The 1-month mandatory reconsideration clock starts on the date printed on the letter. Number 4, the new eligibility verification power covers universal credit, pension credit, and employment and support allowance. And the data returned to the DWP is narrow name, sort code, account number, date of birth, balance. Number 3, the 2nd of June 2026 PIP regulations extend award length. They do not change eligibility. Number 2, and this is the one most of you came here for, the state pension is explicitly excluded from the new bank monitoring power and cannot be added by regulations. Number 1, pension credit has a £10,000 capital disregard and no upper savings cliff. The £16,000 figure does not apply. 3 things you can do this week. 3, verify your own position by logging into your online personal tax account or your online Department for Work and Pensions account, both reachable from the government's official website, and look at what benefits you actually receive. 2, if any DWP letter is currently on your kitchen table, Citizens Advice is the right first call. Their guidance on mandatory reconsideration is published on their website in plain English, and the helpline is listed there too. 1, if you have been quietly avoiding pension credit because you thought you had too much in savings, take 10 minutes to read Age UK's published pension credit fact sheet and consider speaking to a licensed advisor before deciding whether to apply. If you know a neighbor, a parent, or a sibling who has watched one of those viral videos this week and gone quiet, this is the video to send them. The single sentence about the state pension being explicitly excluded does more for someone's sleep than 100 reassurances from family. Please pass it on. Next time we walk through pension credit itself, who qualifies, what it actually pays, and the gateway benefits that come with it. Because if you've just learned today that the savings cliff you feared does not exist, you may want to know what else has been quietly waiting for you. Until then, keep questioning the headlines and keep checking the source. Look after each other.